The language of the budget that decides your pocket. The complete story from the finance bill to the fiscal deficit. Imagine this. On budget day, early in the morning, the TV is on. A live view of Parliament on the screen, the red briefcase in hand, and a running ticker below. A big announcement is coming. The stock market is restless. Rumors are flying on social media. And in the common person's mind, there is a strange mix of fear and curiosity. Will taxes go up this time or come down? Will inflation ease or pinch even more? But in all this noise, some words keep coming up again and again. Without really understanding them, we start forming opinions on decisions. Finance bill, direct tax, indirect tax, disinvestment, fiscal deficit, revenue deficit. These are not just government terms. They write the story of your salary, your EMI, your job, and your savings. Today we'll try to make this language of the budget simple, human, and easy to understand. Every year, the union budget is not just the government's accounts. It is, in a way, the country's collective diary. It records what we earned last year, where we fell short, and which path we want to take in the coming year. When the finance minister presents the budget on February 1st, she is actually laying out a roadmap, the economy's GPS. But to read this GPS, you need to understand the language of the budget. Otherwise, you remain limited to headlines. The heart of the budget is the finance bill. The name sounds technical, but in reality, this is the document that gives the government the power to impose or change taxes. In simple terms, the finance bill is the government's permission letter, which it wants Parliament to sign. If the government says income tax slabs will change this year, corporate tax will get relief, or a new cess will be announced. None of it applies unless the finance bill is passed by Parliament. Here's an interesting and slightly scary fact. The finance bill is introduced only in the Lok Sabha, and if the Lok Sabha rejects it, it is treated as a loss of confidence in the government. In other words, if the finance bill falls, the government falls. That's why the fiercest battles between the government and the opposition during the budget are fought around this issue. It's not just about taxes. It's about power. Now let's come to direct tax and indirect tax. The moment people hear these two terms, reactions differ. Direct tax is what goes straight from your pocket to the government, like income tax, TDS cut from your salary, or the tax you pay at the end of the year. It goes directly into the government's account. Corporate tax also falls in this category, where companies pay tax on their profits. The logic of direct tax is simple. Those who earn more, pay more. Indirect tax is a bit tricky because you don't see it hitting you directly. You go to a shop, buy something, and the tax is already included in the price. GST is the biggest example of this. Petrol, mobile bills, hotel food. Indirect tax is hidden everywhere. That's why many people find indirect taxes more painful, because they are collected almost equally from the rich and the poor. When the government increases or reduces indirect taxes in the budget, the impact is directly felt on inflation. GST rates go up. Things get expensive. Rates go down. There's some relief. That's why, on budget day, the common person's eyes are fixed on indirect taxes, even if they can't explain the terms. Now let's talk about disinvestment, which sparks debate in every budget. Disinvestment means the government selling its stake in its own companies. When the government reduces its shareholding in a PSU, partly or fully, it is called disinvestment. The question is, why does the government sell its own companies? The answer is simple. It needs money. The government has two options. Either raise taxes or sell its assets. Disinvestment is the second option. It brings in immediate cash, which the government can use to run expenses or reduce the deficit. But critics argue that in the long run, it reduces the government's income. That's why disinvestment is always a politically sensitive issue. Now we come to the word that makes headlines sound scary. Fiscal deficit. In simple terms, fiscal deficit means the government spends more than it earns. When the government's expenditure exceeds its income, it has to borrow to fill the gap. This borrowing is called the fiscal deficit. Fiscal deficit is expressed as a percentage of GDP, so its weight can be understood relative to the size of the economy. If it rises too much, investors get nervous, rating agencies raise questions, and the risk of inflation increases. But if it's too low, it can also mean the government isn't spending enough to support the economy. That's why finding the right balance in fiscal deficit is one of the biggest challenges. Closely linked to this is revenue deficit, a slightly more subtle concept. Revenue deficit occurs when the government's day-to-day income falls short of its day-to-day expenses. In other words, the government can't even meet expenses like salaries, pensions, and interest payments from its regular income. This signals that something is wrong with the basic health of the economy. If revenue deficit is high, it means the government is borrowing just to keep things running without creating any assets. That's why economists consider revenue deficit more dangerous. It leaves nothing behind for the future. In the language of the budget, all these terms are deeply connected. Direct and indirect taxes generate government revenue. Disinvestment and borrowing provide extra funds. Together, these form the government's total income. Based on this, Expenditure is planned. Capital expenditure and revenue expenditure. And when spending exceeds income, a deficit is created. Capital expenditure is spending that is expected to generate income in the future, like highways, railways, and power plants. Revenue expenditure is spending on day-to-day operations. In the budget, the government tries to increase capital expenditure because that is what drives growth. Now think about it. If you don't understand these terms, how incomplete does your opinion on the budget remain? Some say the budget is very good. Others say the budget is useless. But the real question should be, how did the tax structure change? Is the deficit sustainable? Is spending future-oriented or not? That's why the budget is not just for experts. It's important for ordinary people too. Because the decisions taken in the budget shape your life for the entire year ahead. Your take-home salary, your savings, your job security. All of it is connected to these terms in one way or another. Every budget tells a story. Sometimes it's a story of restraint, sometimes of expansion. Sometimes the government tightens its belt. Sometimes it opens the spending taps to boost the economy. But the language of the story remains the same. Finance bill, tax, deficit, disinvestment. Once you understand this language, the fear of the budget disappears and curiosity turns into clarity. So the next time the budget comes and heavy words fly across the TV screen, don't panic. Remember, these words are not complicated, just unfamiliar. And once you understand them, the budget stops being just the government's story. It becomes your story too.
If our video has taught you something new, do not forget to like and share this video so that this information can reach others as well. Your likes and shares are a source of inspiration for us. If you have any questions or suggestions, please let us know in the comments. It will be our honor to answer your questions and listen to suggestions. And yes, if you like our content, subscribe to the channel and press the bell icon so that you stay connected with every new story. Thank you. GRT Business YouTube channel sources, news from various news agencies, opinion polls and other public sources. We try to ensure that every report and summary is accurate and verified, but we are not responsible for any dispute or error. Our aim is only to provide you with accurate information.